We've had some rather surprise changes announced to the corporate intangibles regime. Historically, when a company buys trade and assets, then it wouldn't be unusual for an element of goodwill to be purchased as part of the business trade and assets deal. And the company has been able to obtain relief for the write-down of the goodwill in line with accounts amortisation for any goodwill that it purchased as part of the deal. Historically, that goodwill would be comprised of the difference between the price paid for the assets and the assets that are passing. So effectively it would reflect things like customer base, reputation, etc. of the business. The company would get relief for it, written over a period of years. But surprisingly, as I say, this has been sort of cut short with effect from today. So any business that's bought, any trading assets with a goodwill value, the company will no longer get relief for the goodwill amortisation. What will happen instead is that when the goodwill is disposed of at some later date, should it be disposed of, then any loss arising on the goodwill will actually be allowable or deductible as a non-trade debit. In terms of what this means, well, it certainly means that where we have this debate over whether or not a company should buy shares or whether it should buy trade and assets, historically, over recent years, trade and assets would tend to be argued for by a corporate purchaser on the basis that there would be an allocation to goodwill ordinarily and tax relief would flow from that. What it does mean now, though, is that without that goodwill relief, we will probably be back in a situation where most corporate purchasers will argue for a share acquisition as opposed to trade and assets. This has several advantages, one of which may be that on a future disposal of the shares, capital gains tax may not arise because of the availability of other reliefs such as substantial shareholdings exemption.